Hey everyone, welcome back to Corporate Decoder, the place where we look at company reports so you don't have to. Today we are diving into a report from SafePro Group Inc. And let's just say after reading this, I'm not feeling too safe about their financial situation. And before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below where we can discuss these filings in detail. SafePro Group just released an update describing how they raised money. They sold some special stock and warrants, which are basically options to buy more stock later. The key takeaway is they got a little over $1 million, but the terms of this deal could significantly impact the company moving forward. We'll dig into exactly how. Okay, let's get into it. This section is all about a deal they made on May 9, 2025. SafePro Group, which we will call the company going forward, needed cash, so they sold something called Series C convertible preferred stock to some investors. Basically, they sold these investors a special type of stock that can be converted into regular stock. They raised $1.05 million this way. So what's so special about this Series C preferred stock? A few things first. Each share has a stated value of $1,000. When the stock is issued, it will be fully paid and cannot be further charged for thanks to people who own this special stock get dividends, which is like getting a share of the profits, just like regular stockholders. Here's where it gets interesting. The investors can convert their preferred stock into regular common stock at any time. The initial conversion price is $2. Price can change. If the company does things like split its stock or issue a stock dividend, the company has the right to buy back all or some of the preferred stock at any time for $1,100 per share. If the company is sold or goes out of business, the preferred stockholders get paid $1,100 per share before anyone else, including the regular stockholders. Despite all these perks, the people who own this preferred stock don't get to vote on company matters. Besides the preferred stock, the investors also got warrants. Think of a warrant as a coupon that allows you to buy stock at a set price within a certain time frame. These warrants let the investors buy shares of the company's stock for chat, and they have 3 years to use them. However, they can't use the warrants if they don't have the ability to sell the stock. The investors also can't use the warrants to buy so many shares that they would own more than 4.99% or 9.99% 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 of the company's stock. The investor gets to pick if they want it to be 4.99. 4.90. The company promised to file paperwork with the SEC, the Security Exchange Commission, so the investors can resell the stock they get from converting the preferred stock and using the warrants. All of this was done privately, without registering with the SEC, using special rules that allow companies to raise money from certain qualified investors. Now, let's talk about what this all means. The company needed money and they got it, but it came at a cost. The investors now have the ability to convert their preferred stock into common stock, potentially diluting the ownership of existing shareholders. Also, the warrants could create even more dilution in the future. Here are some key numbers you should pay attention to. They raised $1.0 AL and money the company got. The conversion price is $2.25. That's the price at which the preferred stock can be converted into common stock. If the common stock is worth less than $2.25, it is not a good deal for the investors to turn their stock into common stock. The warrant exercise price is $2.93 per share. This means the investors can buy shares for $2.93, hopefully profiting if the stock price goes above that. If the common stock is worth less than $2.93, it is not a good deal for the investors to use their warrants to get the stock. So what's my take on SafePro Group? Well, they're a small company that clearly needed cash. They've chosen to raise money in a way that gives a lot of power to the investors. If the company does well, these investors will profit handsomely, but it could be at the expense of current shareholders. And the big risk here is dilution. If the investors convert their preferred stock and exercise their warrants, the number of outstanding shares could increase significantly, reducing the value of each existing share. On the other hand, maybe this cash infusion will allow the company to grow and become profitable. If that happens, everyone could win. But for now, it looks like the company is in a vulnerable position. Alright, that's our breakdown of SafePro Group's latest filing. What's your take on these numbers? and what they signal for the company's future. Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.